Thursday, May 29th, 2019, Maneco 64, home of alternative economics and contrarian views. This morning, I want to talk about whether the Fed, the present-day Fed, has made the same mistake as the Fed of the 1920s, especially of 1929, and whether we're going to see the same consequence that we saw in the late 20s, early 30s of the Fed's policy of basically first inflating the system, how they did back in the roaring 20s, and then actually reining in credit too much, too quickly, which led to the collapse of 1929 and the Great Depression. I will speak about the market after I speak about this. Markets are very interesting at the moment. And to look at this, I'm going to look at this book, which I'm still reading. And it's a very interesting book, War and Gold by Kwasi Kwarteng. Ironically, he's a member of parliament here in the UK, but he's written a really good book, in my opinion, about war, gold, a 500-year history of empires, adventures, and debt. I recommend the book. I haven't finished it yet, and going through it slowly. I have other books that I'm reading at the moment, but I want to start at page, let's have a look, 123. And this chapter is Victors and Vanquished, and just a very broad outline of what happened in the 20s. The United States ended up being the biggest creditor nation in the world. A lot of gold flowed into the U.S. because that was, under a gold standard. And why did that happen? Well, because the U.S. Stayed out of World War I for, most of that war came in just in the last year. And before that and during that, the U.S. Economy provided a lot of material, weapons, everything for the Europeans. They lent the money. So at the end of World War I, the U.S. was left like as the banker to the world. And don't forget, we had the Federal Reserve, just created in 1913, started operating during 1914, right when the war started. Was it a coincidence? I don't know, but I leave that to you to ponder. So with that, all the gold, that meant more money. The credit boomed in the 1920s. He talks about how also installment purchases became, big. Speculation in real estate, land, was huge in the 20s, and a part of that was because the U.S. had a lot of money from World War I, and the other thing that he talks about is that the U.S. had to, they kept a loose monetary policy, especially the Federal Reserve Bank of New York, because they wanted to help bring the Britain back to the gold standard. They rejoined the gold standard in 1925, and they joined at a very high rate. So the U.S., Benjamin Strong, who was the head of the New York Fed, felt that Europe, in order for Europe to recover after World War I, Britain had to get back on that standard, and they had to help keep the dollar relatively weak so that sterling would be able to stay in the gold standard at such a high level. So that's the general idea here. But on page 123, this is what they actually did. And I'm quoting here. Too strong, Britain's stabilization within the structure of the gold standard was the cornerstone of the European financial reconstruction. The Federal Reserve in Washington, under Strong's guidance, lowered its discount rate, the rate at which the Federal Reserve lent funds to the commercial banks, from 4% to 3.5% towards the end of 1927, before being raised from that low in January 1928 to reach a high of 6% on August 9th, 1929. Benjamin Strong had died in October 1928. His successor as governor of the New York Federal Reserve Bank, George Harrison, suggested an increase in the discount rate of 6% as a warning against excessive use of credit. So, yeah, Ben Bernanke, of course, he's written about it, I think, or talked about how the Fed, he admitted the Fed made a mistake back then, because aside from raising rates like that, they also kept rates quite high for after the crash of 29. And he said, we have learned from our mistakes. I don't think so, actually, because you go back now, I would consider the '08 crisis, let's say, '08 crisis, the crisis like World War I back in 1918. And then, all the major central banks under the guidance of the Fed have kept, rates at zero or almost negative for even longer than we saw, I would say, during the 1920s. And then we get the Federal Reserve, especially under Jay Powell, after Yellen leaves, starting to raise rates. And they raised it from, let's say, 0.25%, I think it was, to 2.25%, 2.5%. So you might think, well, but the other Fed raised it from 3.5% to 6%. Yeah, but percentage-wise, from almost 0 to 2.5% is a huge rise. And don't forget, they also did the QE, right? The money printing. They printed over $3 trillion in this in the modern day. Back then, I guess the QE was all the money that came in from Europe during the war. But that was earned, though, because, the American industry and economy produced things to sell. QE was just created out of thin air. On page 126, the author goes on to say, Friedman and Schwartz had offered a powerful monetarist explanation of the role of the Fed in deepening the Depression. Bernanke, in his laudatory speech, mentioned the anti-speculative tightening of 1928-29, when the Federal Reserve discount rate moved from 3.5% at the beginning of 1928 to 6% in August of 1929. So has the present day Fed made the same mistake as the Fed, especially the New York Fed of the 1920s? I think so. I think Jay Powell will be remembered as the man who tightened policy too much. And am I saying that I'm pro-Fed and that I think Jay Powell should start cutting rates and that he shouldn't raise rates? No. As many of you know, I'm very anti-central banking. I don't think we need central banks. Central banks create a moral hazard, and they're not necessary in a free market economy. I think the markets should set the price of money, not a 12 men in a boardroom in Washington, D.C. So with that, let's look at the markets and see how I think what we're seeing in the stock market, especially here, is pointing maybe to something like 1929. And it makes sense because, as the Austrian school says, every credit boom will naturally be followed by a credit bust. And we had the credit boom in the 20s as a result of all the credit all that money and gold that flowed into the U.S. And as a result of the Federal Reserve's loose monetary policy. And we've had the same credit boom since the collapse of '08. And I would say that this credit boom has been even bigger than the one in the 20s, because in the 20s there's still the anchor of gold in the system. Nowadays there's no limit. So let's quickly look at the markets, see what they're doing this morning. It's just about it's 10 to 8 a.m. London. Yesterday, of course, the Dow dropped over 200 points. S&P dropped about 24. NASDAQ dropped about 0.4%. So let's see where we are. Gold and silver did get hit hard yesterday, and I'm still not concerned about it. It's still the only safe form of insurance, in my opinion, for a deflationary collapse or a hyperinflationary collapse. So this morning we've got spot gold up $5 at $12.84. The low's been $12.78.70. And we are right here near the highs here. 12.84.50 is the high. Silver is up 7 cents at 14.42. Range has been 14.32 to 14.43. I think silver got down to around 14.27 yesterday. Yes, we could go a little lower, but not much lower in my opinion. We are almost near the 2015 low in silver. The stock market is continuing to move lower. The Dow right now is down 115 at 25,224, 0.45%. S&P is at 2786, down 14 or 0.5%. Before I go further, I just want to show you a chart of the S&P that I actually tweeted out yesterday. Aside from, the rising wedge, which I have deleted here, because I want to focus, and we've broken the rising wedge, but I want to focus on the head and shoulder formation here, this top in the S&P. I tweeted out yesterday that we closed just below that head and shoulder, which we did, or just at that head and shoulder, but I think it was just below it. And you can see that this morning we're actually breaking comfortably below that head and shoulder. What does that mean? That means that once you break the head and shoulder, the market should go down, the distance from the neckline to the top, a perpendicular line. So it's from around, let's see, 27.95 to 29.60. So that's over 150 points. The S&P should drop from the neckline, which is around 2,800. So you're looking at about a target of 28,650. Is that the target for the bottom of this, in my opinion, bear market, actually, that started last year? No, it will probably be a lot lower. A lot of analysts, cycle analysts like Nanner and others are calling for a bottom maybe in 2020, 2021. But in the medium term, I think we could get to 2650 in the S&P. Is it going to happen today, tomorrow? I don't know. That's the thing about technical analysis. Difficult to tell when, but in my opinion, it's pointing to a move there. And the other thing that is really pointing to trouble is the bond market. And I'll cover the bond market right now. Yesterday, I noticed the bond market started moving higher in the morning when the stock market was higher, and I thought there's something wrong here. I mean, the 10-year yield dropped like 6 basis points. This morning has dropped another 4. We're at 223. So now the 1 month T-bill is at 236.50. So the curve is now inverted like 13 basis points. There is definitely something wrong here. There's a massive run towards safety. And I use the air quotes because I don't think they're safe treasuries. They're just another paper asset. But yeah, and this morning we're continuing lower. So that's the bond markets. What about the currencies? Currencies are pretty steady again, even though the dollar did strengthen yesterday. The pound is at 126.55, unchanged. Euro 111.60, unchanged. The dollar's down 0.17% against the yen, Japanese yen at 109.20. And the dollar's fairly strong. It's rebounded a bit against the yuan. It's at 693.40. Crude oil continuing to move lower. WTI is down 72 cents or 1.2% at 58.45. Brent crude 68.09, down 1%. There you go. I think the Fed has made the same mistake it made in the 20s. It's created a massive credit bubble. like it did in the 20s. It did the same since '08. And then you've got Jay Powell, who made the same mistake that Harrison, who took over from Benjamin Strong in 1928 when Benjamin Strong died, made the same mistake as him. Raise rates too quickly. Why have they made the same mistake? I think it's because they were in a situation that they'd never, the markets and the monetary system had never experienced before, both in the 20s and both since '08. In the 20s, it was the massive inflow of gold after the end of World War I, because of the position of the United States of being, the provider of all or a lot of the stuff, for fighting that war. And then in the present day, it's because central banks, not only the Fed, but other central banks have conducted a monetary policy that's unprecedented, even unprecedented compared to the 1920s. And they don't know what the consequence of a rise in rates from almost 0 to 2.5 is going to be, plus the unwinding of the balance sheet. So look out. I think the 1930s is going to look almost like a picnic, in my opinion. If you enjoyed this video, make sure you hit the like button. Make sure you subscribe to the channel if you haven't yet. Make sure you share my videos far and wide if you think others would enjoy this kind of content. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.